Hello and welcome to ACY Securities podcast. This is in fact our first podcast that we've ever conducted. You may have heard my voice before from some of our videos and webinars, but my name is Alistair Schultz and I'm going to be the host through your trading journey. Now, in all of this stuff that we've done in the past, it's usually been through the YouTube channels and or our webinars that I host as well, and I am the Chief Market Analyst for ACY Securities. But today I'm lucky enough to have Charles Blakey, who happens to be the co-author of my book, The Essentials for Trading Students. And today we're going to be talking to him about a few different things that might be relatable to someone that is trading from home, some of the do's, the don'ts, and just the other stuff that goes along with trading from home, including maybe things that you might be able to gain some wisdom from. So I'm going to introduce you to Charles now. Say hello, Charles.
Hello, Alistair. Thank you for having me.
And very much a pleasure to have you here today. Now, when it comes to trading, we've got to want to give the guys listening in on this a little bit of insight as to what maybe got you interested in trading in the beginning.
Well, honestly, I've probably been interested in trading and the markets for since I was at university. I was at university studying medicine at the time, but was never totally comfortable there. And on a number of occasions, I actually sort of took a break from medicine and was starting to go to trading courses and particularly stockbroking business courses and that sort of thing. But at the end of the day, I finished up back in medicine, which is where I then spent the next few decades.
So did that change, and like as you progressed through your medical career, to find that you ended up, what sort of inspired you to start trading again, I suppose, is really the question I'm asking.
After about 15 years, something came across my desk, and it was just a bit of an advertising blurb, and it piqued my interest, I suppose. So I got in contact with them, and that was really the beginning of the trading journey.
And how long ago was this roughly now?
That was about 1997.
Okay, so were you using paper trading sort of stuff, getting your prices and plotting them into a graph paper back then? Or?
Well, at that time, there was no internet like it is now. There was certainly no internet trading that everybody is mostly familiar with. So each morning I would have to get the newspaper, the Sydney Morning Herald as it was, and look up the results for the previous day's trading on the share price index, mark it up on my paper chart, which was a large 4 by 3.5 foot chart paper, mark it up in pencil and begin to make my trading decisions from there.
Do you feel that like the change between the paper trading and internet trading has made a massive difference in how you sort of look at charts compared to what you used to? Is there a differentiation between the idea of or how you traded or what strategies you might have used back then compared to now?
For sure. Not all of it good though. I think when computer trading began to hit the market, that is the traders market, not the financial markets, we were exposed to having a much larger range of things that we could trade with, and we were exposed to being able to do that all at once, and of course relatively quickly, and not just on a daily time frame as you were before, but now you could do it on an intraday time frame. So we were suddenly hit with a lot of extra information, a lot of extra facility to be able to trade all sorts of things that you just couldn't have conceived of previously.
It's interesting because I started obviously in the .com sort of an era. I was brought into the trading from a digital side. I've never seen the paper trading sort of stuff and traded it personally in that sort of way. So in terms of the way that strategies are comprised now, do you find that they're better now or worse than or worse in what's systematically available?
It's not so much a question of better or worse. I think that one of the benefits of having worked with charts on paper and having to get your information out of a newspaper each morning is that you had plenty of time to consider what was going on and to make decisions about your trading and to actually put in plans that revolved around setting up a take profit and a stop loss and your entry point at the beginning of the day, and then you walked away from it because there was no other choice. These days, I think it's, in some respects, it's easier because, you know, you can have immediate access to the data. You can make trading decisions on the fly, even while you're in your car driving. If you have your mobile phone set up on the windscreen, you can actually even be watching your charts at that particular point in time. And so people are tempted to actually be making spontaneous and not always well-considered decisions.
I mean, I'm not sure about putting up my charts while I'm driving, but I can think of certainly times where I've been sitting in the train doing that. Now, so you started sort of trading in 1997.
Yes.
And I imagine you've read a lot of different books along the way that have sort of inspired you to change either trading strategies. Have you got any books that you would recommend to perhaps new traders or readers?
Look, I think that one of the difficulties with trading books is that most of them promote a particular methodology or approach. And many of those books are excellent in terms of providing information about that particular methodology or approach, but there really aren't many books out there that you would describe as a cohesive textbook like you might get at a...
You mean like the one we've written?
Well, something like that. Having said that, I think there are two books that stand out, or two programs that stand out. One is the one that actually got me interested, which was Safety in the Market, which was written by David Bowden. And he developed his approach from W.D. Gann, who made his mark in the earlier part of last century. And David's approach was to, in his words, to interpret Gann's writings, which are a little bit obtuse. And that was certainly a useful place to start because it really gives you some really good basics. And I think the next book that I really got involved with was Trading with Dinapoli Numbers, which is in fact a play on the Fibonacci numbers. But Joe Dinapoli wrote that book, and I thought that was also an excellent book and provided a fairly straightforward but comprehensive approach to trading with that particular methodology.
That's interesting that you say that, I mean, because I've found that Fibonacci numbers and Dinapoli numbers are sort of my go-to sort of numbers when it comes to using anything. I figure if there's any luck in Fibonacci or Dinapoli, I kind of want to have it when I'm trading. But I mean, moving on from a bit of that, I mean, tell us about what you're doing now. What are your current trading sort of setups? How many monitors do you have, or using it off a laptop, or anything along those lines? Do you have maybe two different variations that you tend to go to?
Well, probably to answer that question, you go back to, you know, I've traded with paper, you know, pencil and paper, literally. I have gone to the other extreme and sat in front of computers with 6 monitors where I'm watching, you know, enormous number of different things at the one time, with information coming from news feeds and data and what have you. And these days I believe you can trade really much more successfully just with a single screen on a laptop. You don't really need to be watching that much information.
And what would you pick in terms of a market if you were? Are you predominantly going to look at stocks or FX or anything variances of the two?
My two areas of interest these days are really just one or two of the FX markets, which is, I don't have a particular market that I would only trade, but obviously the Australian dollar is a useful thing for me to look at. But as for the other one, it would depend on what is going on in the market. And you know, once a month or so, you might actually have a look at what's going on in the variety of markets and try and pick one that you want to try and work with. And you might also be working with the share price index.
So these days, I mean, your trading has almost gone back in time to what you started with paper trading, just with a digital screen. You're really focusing on one market at a time to put as much concentration or focus into each one.
Well, you know, not quite back in time, but yes, I've found that you are probably better off by not spreading your interest too widely.
Okay, that's interesting to hear. I mean, I agree. And in terms of time frames, I mean, daily charts still applying for you as well?
Well, again, I've traded everything down from the 1 minute time frames to the daily time frames when I first started. And these days I trade on a daily basis, but I'm quite happy to look at hourly time frames as well.
Is there a particular reason why you prefer those two time frames?
Look, there are. I mean, to some extent, the rationale is that to trade. I think the appeal of trading short-term time frames is that you can tell yourself that, well, I'll only have to, trade from a certain time of the day to another time of the day, a few hours away, and in that time I can, really make some good money and have enough happening at that time to really work out what's going in the market and do a good job. But the reality was that when you're trading in those time frames, that it required a level of focus that is hard to maintain for a number of hours at a time, and you really need to be in a position where you've got data coming in on the spot. You can't afford to have anything delayed. I mean, certainly your price data you can pay for and you don't get that delayed. But when you're getting news data coming in and you actually need access to that news data, it's actually extraordinarily expensive to be able to support that in that environment, and it's just too stressful. So I found that pulling myself back to a daily time frame where I might look at charts during the day for hourly data for maybe a better entry or better exit, if I'm expecting an entry or exit of that on sometime during that day, then that's actually good enough for me.
Okay. And so do you find yourself, I mean, when you first started out, when you're plotting and dotting sort of on graph paper, was that more of a using sort of mechanical systems and sort of technical strategies? And have you progressed in any other way along your sort of trading career?
Well, the journey has taken me through a lot of different approaches, and I think that when I first started trading with the safety in the market, it was really more of a discretionary approach. And similarly with the Dinapoli work was a discretionary approach. So both of them had a number of key entry points or patterns that you would be looking for, and then they would use other criteria maybe to work out whether or not that entry or exit was a good or a bad place. I then moved into a more systematic approach, and then that led into algorithmic trading. And whilst we were doing the algorithmic trading, I became involved with doing some development work for a small hedge fund, and that opened a whole other new world of trading that would otherwise have not been open to me. But in the end, I decided that trading is a bit like medicine. Really what you're trying to do is to form a diagnosis about the market and to use whatever information you've got at hand to form an opinion about whether the market is going to go up or down and under what influence, and you make your decisions based on that.
So it's almost like gauging the health of the economy is how you've transcribed your sort of actions.
A little bit, but what it really is that it says that you need to have a broad approach, a broad knowledge, if you like, of what's going on. So I certainly do not discount, technical patterns that you observe, but you have to put that into the same frame as the fundamental things that are occurring and anything else that you might see.
And so these days you find yourself to still be on that sort of discretionary scale of...
More so now than ever before.
Yeah, okay. And what are your thoughts about the general market right now? Are there certain things that you think are different to what it was like back when you started trading in the 90s compared to perhaps GFC and then now what we're seeing with COVID-19?
Well, I've certainly been through a number of periods where the market has gone backwards for a while, and sometimes dramatically so. The GFC saw some pretty exciting moves, and as you know, we've seen some pretty big moves recently, and I think that you have to look at all these things as being just another day in the market. If you trade for long enough, you will come through these cycles, and they can be exciting when you're going through it. But at the end of the day, it is just another day. And your job as a trader is not to get too excited by whether the market's going up or down. It's to understand what it's doing, have some idea of why it's doing it, and make some decisions based on that.
And hopefully take advantage of the situation.
In order to do that, yes.
If you were to start again, what sort of advice would you give yourself knowing what you know now? Or even in fact, if there was someone new to trading and all the years of wisdom that you have with trading on your own, what would be the thing that you tell them to sort of think about from the onset of where they start?
I think the danger for people who start trading is that, particularly with so many companies out there looking to attract students into their programs, is that many of those programs are very focused on a particular methodology. And I wouldn't say that any of those methodologies are necessarily bad or wrong, but it is still just one methodology. And I think the thing that I found frustrating, and I didn't really realise how frustrating it was until years down the track, is that you learn a methodology, it seems like a great idea, and often it is, but it has limits. And you don't really get taught about the limits in those courses. You don't get to understand where the market will actually benefit that particular approach, and indeed what other approach might actually begin to work in a different kind of market, because there are many different kinds of market that last long periods of time. So I think my recommendation to traders who are just starting out is to try and become a student of trading rather than just developing a particular approach.
And what about for yourself? I mean, what would you go back and tell yourself when if you could go back to 1997 before you saw that piece of paper on the desk? What would be something from today about trading that you would consider telling yourself that might have changed the odds? I mean, naturally, obviously, going pick these stocks for 2008 GFC and or these ones for COVID-19 are the obvious, but outside of that.
It would be much the same message, and that would be to try and develop an approach that allows you to learn a wide range of strategies and techniques and skills. And instead of it taking me 10 years to actually do that, you can put together yourself a schedule, if you like, that will take you through all the various things and probably do it in 2 years instead of spending 10 or 12 years learning how to actually get there.
Have you ever sort of kept a trading journal to sort of keep up on some of these ideas that you have? I mean, naturally, you've got the book, The Essentials of Trading Students, and I suppose in some respect that acts as a bit of a journal of history. But have you sort of kept journals, and do you keep them up now?
Look, the only time I kept a trading journal was when I was having some trouble with trading decisions, and those trading decisions were anxiety-based. And so the idea of the journal was simply to help me to kind of get a grip on that. I frankly didn't find it very helpful, and I haven't really found journaling to be very helpful for my trading at all. The idea of breaking rules and journaling is sometimes put forward, and as a way of helping you to kind of analyse why you might have broken a trading rule. But since I don't really trade with strict rules, I'm far more discretionary, it really didn't sort of meet my needs. I've actually found that of more importance than a journal is to actually have a coach. And I think having a mentor or a coach that you maybe talk about things with fairly regularly, whether that's once a week or once a fortnight or something along those lines, is really of much more value.
So how do you go about finding a mentor or coach?
Even when you're trading from home, which can be a little bit isolating, you should, and I would encourage people to get involved with trading groups, even where those groups are run by somebody who is promoting a particular program. It can be really helpful to make yourself known to the people who are obviously senior traders, in those areas and make an arrangement with them. I over the years did that a number of times and found that in the end I was really working with just a small handful of people, and we would quite often, if you like, trade together, even though we were literally on the other side of the planet. We would be connected via Skype if we were actively trading in short-term markets, and we would be able to keep each other company and deal with any anxiety of those sort of things. And then once every week or so we would have a bit of a sit down and discuss what's been going on the last couple of weeks, and I found that to be very helpful.
So, I mean, in terms of that sort of social trading element, do you see that there's a great distinct advantage to trading socially with other people, or is it more the idea of sort of following someone else's trades? I mean, have you used either method before? I mean, it sounds like from the way that you've sort of found a mentor or someone to trade with, it's that social element that's come into it, but not so much the doing the same things as one another in terms of your trading outcomes.
Not at all, and I wouldn't call that social trading. But all that I'm suggesting is that the isolation of trading on your own can be circumvented to some extent by doing it with a buddy. But social trading itself is a different concept altogether. Social trading implies that you are able to see how other people are trading, and particularly other people en masse, and that you are able to basically take trades with the group. Now, I'm not a fan of that, because if you are doing that, then you are effectively using other people's trades as a lagging indicator.
And you therefore then don't have the logic behind why those trades are taken either.
Well, you don't have the logic behind it, but if the logic really is that if a lot of people, or if the majority of the people within this platform are taking a short, for instance, then hell, you want to be trading short with them. The trouble is that by the time these people have all gone short, the market may have already run out of steam. You don't know really what started that movement off, and you're really not making your own trading decisions. So for me, you'd rather not be trading in that sphere, because the information you're getting is actually quite delayed. If you were able to get that same information about where the market makers are putting their money, then I think that would be different, because more often than not, that's where the market gets pushed from.
But, I mean, earlier we were talking about the idea of trading rules, and you being a discretionary trader, you tend not to run by the rules, or if there are any rules, because it's not systematic trading. So you don't have planned entries and exits as in the same sort of context. Are there a particular set of rules that you do still apply to your trading day, even if it's not related to the actual trading itself?
I think the most important rules are your money management, and you need to be very careful that you are not over trading. You don't want to be over investing in any given position, but you also don't want to be taking too many trades at the same time, which is in fact one of the reasons why I pulled back to just trading a couple of things more slowly. I think that understanding risk management is one thing that you do need to pay a lot of attention to, and again is one of those things that's not really emphasised enough in some of the teaching programs that are around.
Well, that's an interesting way to sort of put your discretion, your rules in place. And is there a way when you're in discretionary trading, or a place that you know you're in sort of, say, the wrong position or in the wrong way on a particular position?
Well, if you are trading in that fashion, you will always be analysing what's going on. So if you have entered a position at any point in time, you should always be looking at what's going on. If that chart or that trade is going against you, you do want to be looking at it and seeing if there's a reason for getting out by this time. If the market is telling you, if your diagnosis is that, well, look, the market has actually reversed, then you don't have to hang on to a trade that you know is going to go against you.
So your sort of criteria is if you're already in the position, you've already got a set entry and exit for it that you've already decided, but you feel or you see from a discretionary point of view that trade's done, you just kill it then and there?
Oh, sure. But it's not on the basis of how I feel. It's on the basis of the data that's available to me.
Yeah. And, I mean, in instances, I mean, losing streaks and winning streaks have always been a part of trading. And, I mean, I've always found it's important to not be elated by a winning streak and to certainly not be self-depreciating when it comes to a losing streak. Is there any other tactics that you might use to sort of control that sort of feeling and to treat it more business-like?
I think that this is potentially where discretionary traders can find it a little bit harder. If, for example, you're a systematic trader, purely mechanical, then, and if you've done enough work on your system, then you will know how many failures you are likely to experience and how many wins you're likely to experience. So that will actually give you a good guide. As a discretionary trader, that is not quite as open to you, but even there, as a good discretionary trader, you should understand the success rate of each of the patterns that you use, or each piece of information that you use needs to actually be based in some kind of data. So if, for example, you've gone into a trade on the basis of a double bottom, you will need to know that there's a percentage of those that will win and a percentage that won't. If you are beginning to experience recurrent failures as a discretionary trader, I think you need to have some sense of whether or not your trading capacity is going according to plan, or whether or not this is you failing. And if you decide that this is you failing, you're not making the right call, in other words, then you probably should take a break. Like, some people think of trading as being a bit like an elite sportsman. You will have not only good days and bad days, but you'll have periods where you're in the zone, if you like, and other periods where you are not. And if you are not, then you can do serious damage to yourself if you don't actually pay attention to that. And during that time, you will look at other things that are going on. Are there stresses in your life? Are there other things that are making you anxious? Are there other reasons for your decisions to be faulty at the moment? Is the market maybe just not behaving the way it normally does? All these sorts of things are reasons for you to actually take a step back and have a think about it. But it's all about reviewing your position. You're making a diagnosis all the time.
It really makes the idea that trading is a very personal journey, and how it actually transpires through your life and where you start with your trading journey and to where you end with it is, all dependent on each individual.
There are no two traders who will do exactly the same thing. I would say that even people who are trading with algorithms will do it slightly differently, because algorithms always have the choice of being able to be turned on and off at different times.
And the level of interpretation that each individual has to actually what they're seeing on the chart, that human element will vary between person to person.
Well, yes, but in a situation where you have an algorithmic trader, literally using a computer to generate the trades, they can turn the risk levels up or down. They can turn it on at certain times of the day or turn it off at certain times of the day. And I've certainly seen, the same person use the same algorithm, the same computer program, if you like, to trade with and get different results because of the way they've set it up.
It's an interesting take on how the different ways of things are going to be conducted. What's your sort of view on the current market dynamics right now, and what do you see sort of happening, later on in this year, considering everything that's going on with COVID-19, biosecurity laws in Australia, general price dynamics that we're seeing across the market? Do you think we're going to see more volatility, less volatility? What's your general opinion? I mean, there's no right or wrong answer on these things, but...
Well, the development of the pandemic has led to a considerable level of fear, not just amongst the trading community who are speculating, but in the community at large. And I think that has certainly had a strong influence in the way the market has been moving of late. We've seen the markets fall in most sectors very strongly, and while it seems to have stopped free falling at the moment and is dithering around a little bit, I suspect that we will see more falls to come. These will likely be driven by, the increasing problems that the US is having with COVID-19. They're predicting that the peak of their problems won't occur until later this month, maybe a little bit later. And I think that will certainly be having a major influence on the movement of the market. After the worst is over, then the question will be what effect has this had on the economies around the world, and the effect will be significant. It will take some time, I think, for the market to actually work out what the impact is going to be, how many companies survive, how many don't survive, how many countries have gone into hock beyond what they can easily afford. And after that has developed, or the market's developed an opinion about that, then I think you can look forward to prices beginning to rise again. But I don't believe it will be a strong pull. I think it's likely to be a climb that will occur over time again.
Okay. And in terms of what we're seeing now, I mean, we've seen China starting to have some restart of businesses. But, I mean, we're now seeing that we're not, that, the rest of the world is obviously having dramas from COVID-19, and that they are probably not all that likely to have demand increase on Chinese goods right this very second, because the rest of the world is shut down. So do you see China as having issues, especially knowing that right now we've got a serious number of credit issues already happening over there with defaults in both the personal level and also in business levels?
Well, China's always complicated, largely because the data that comes from there is hard to know whether it's true or false sometimes. That includes not just this information, but just their general economic data is often held with some degree of suspicion. I think on this occasion, it's very hard to tell what the outcome of China's involvement with COVID-19 is going to be, and the impact it's going to have on its business, just like everywhere else in the world.
So right now we're probably looking at the idea of really we should all be a little bit patient about seeing what happens before we rush into long-term positions. I think that ultimately you're going to want to start buying, but I don't know that I would be buying just yet. You'd be waiting for a little bit longer.
I'd like a little bit more confirmation that we're at the bottom, and I think that we won't know if we're at the bottom until we see the final outcomes of the pandemic.
So what about the idea, though, that as opposed to buying at the bottom, you're buying on your way down? I mean, if you're doing it with unleveraged sort of positions, then it's not going to be so much of an implication. Like, I'm thinking more along the stock market side of things here, but in that sort of instance, you can be buying, but I suppose then if you hit the bottom and that company goes with it, then you've just bought a whole heap of stock that's now worth nothing.
Well, you have to make those assessments, of course, but if you buy and you're not at the bottom, then it's not the end of the world as long as you can afford the ride.
That's very true.
But if you are leveraged, that makes it much harder to avoid that ride.
Yes, yeah. Oh, well, thank you very much for attending the podcast today and agreeing to the interview. It's been absolutely sensational to have you on board with us and giving a little bit of insight. And I look forward to sort of bringing you back on board maybe down the track when we can get a little bit more action happening, a bit more clarity to see what your thoughts and opinions are then.
That'd be great, and thanks for having me.